Hey everyone, welcome back to FundRaiseo Academy. I really hope you've been enjoying our videos so far. The questions you've been sending in after our last few sessions on fundraising strategy tell me we're covering the right ground. So keep them coming. This session we are going to have in two parts. First part we are covering now, and the next will be released in the coming week. Also, today's session is one I've been wanting to record for a while because it sits right at the intersection of the two questions every early stage founder eventually asks me: how much of my company do I actually need to give away? And is there a way to grow without giving any of it away at all? The answer, as you'll see, is more nuanced than a simple yes or no. And getting it wrong can cost you tens of millions of dollars at exit. So today we're talking about navigating the capital stack, equity versus venture debt. This is module 5 in our founder and investor education series. And if you've been with us since module 1, you know we like to go deep, not just skim the surface. By the end of this session, you're going to understand exactly how each of these two capital sources works mechanically, not just conceptually. You'll know the real trade-offs founders face with each. You'll work through actual worked examples with real numbers. And I'm going to share stories from pitches I've personally been part of across climate tech, fintech, SaaS, e-commerce, and B2B. So you can see how this plays out in the real world, not just on a slide. Here's why this matters so much right now. Capital efficiency isn't a nice to have anymore. It's the primary mandate investors are judging you on. Whether the funding environment is hot or cold, understanding when to sell ownership versus when to borrow against your future is what separates founders who build resilient companies from founders who wake up on their Series C with barely any ownership left. We're going to move through the mechanics of dilution, the real cost of venture debt, including something most founders don't fully understand: warrants, a side-by-side comparison you can actually use as a decision tool, 4 real-world scenarios, and a hybrid strategy that I personally recommend to almost every founder I advise. Let's get into it. Let's quickly walk through the roadmap so you know exactly what's coming. Though I'd encourage you to watch this one start to finish, since each section builds on the last. We'll start with the capital stack itself, the core paradigm, and how to read the market you're raising in. Then we'll go deep on the equity path, the upside, the trade-offs, and I'll walk you through the actual math behind dilution, because most founders think they understand it until they see the real numbers in front of them. From there we move into the venture debt path, again upside and trade-offs, plus a full breakdown of warrants, which is the part of debt financing that catches almost every first-time founder off guard. Then I'll put both side by side in a comparison you can literally screenshot and use as a decision matrix. After that we get into the fun part, 4 real strategic scenarios, so you can see exactly which situation matches where you are. We'll cover the hybrid approach, which is honestly my favorite part of this whole talk. And we'll wrap with a glossary of terms, a look at the venture debt landscape here in India, a master framework you can use going forward, and my top 5 takeaways. And stick around to the end, because I'm going to break down some real pitch examples, a climate tech deal, a fintech balance sheet story, a couple of SaaS bridge rounds, and more, so you can see this framework in action, not just in theory. Let's dive in. Let's set the foundation. At its core, every growing company needs capital. And broadly speaking, there are 2 ways to get it. You either sell a piece of the company's future, that's equity, or you borrow against that future and promise to pay it back, that's debt. In venture-backed startups specifically, debt shows up as something called venture debt, which is a specialized form of lending built for companies that are not yet profitable, don't have hard assets to pledge, but do have institutional VC backing and a credible growth story. On this slide, you can see 2 cards. On the left, equity, selling a piece of your company's future upside in exchange for patient capital with 0 obligation to repay. On the right, venture debt, borrowing capital that must be repaid with interest, plus usually a small equity kicker through something called warrants, which extends your runway without triggering meaningful dilution. Here's the mental model I want you to hold on to through this entire session. Equity is best when you're funding something genuinely uncertain, unproven R&D, a long horizon bet, a business that needs the network and governance a great investor brings. Venture debt is best when your revenue is becoming predictable and you just need a bridge, working capital, or a few extra months of runway. This is the same reason a bank will lend against your house, but not against your idea. Collateral and predictability change the cost of capital. Keep that lens in mind as we go deeper, because almost every decision in this session comes back to that one distinction: how much genuine uncertainty is still left in your business.